Hello, this is Dean Malone with CompassFX. I hope you're doing well today and you get some good trades. I want to share with you a quick little strategy for trading after a big, large move in the Forex market. As a matter of fact, it reminds me of a strategy that I used to do in trading stocks, and that is the gap strategy. A gap in stock trading is where the stock opens up at a higher or lower price than the previous day. And so we look for the market to fill the gap or to retrace a bit towards the previous day's closing price. In this case, we're looking at the euro dollar. We've had a big move because of non-farm payroll coming out much better than expected. 271,000 was the number, 90,000 more than the market expected, about 180,000. So we get this big move in the dollar. And that caused the euro dollar to make a strong drop to the downside. So what I'm looking for is a retracement. The market stretched a bit too far, and we're going to look for some profit taking. When the market makes these big moves, look for profit taking. That's what causes the retracement. But it's going to move back probably to a certain retracement level. So what I like to look at is I like to look at Fibonacci retracements. Now there might be some other levels involved, but I'm going to keep this one pretty easy. I'm just going to look for the market to make a retracement move about a 23.6, a 38.2, maybe a 50% retracement. It's all dependent upon, do I get higher lows or higher low closes if the market may move down? If the market happen to make a move up, do I have lower highs or lower high closes? Let's go take a look at the euro here. So we see this euro movement down. I'm simply going to grab the fib, and this is the fib retracement tool, and I'm just simply going to put it on the highest high point and the lowest low point during that news announcement. Now as I come into the next day, and this is some trading that I did overnight and we did in the Dodge trade room today, I'm just simply going to look for the market to make a move up to a retracement level. So we see that right after the news announcement, it came up about a 23.6 retracement level. 23.6, if that's all we get, that's typically a sign of continuation if we get lower lows. Well, we see how the market came back down and then bounced and came back down again. So it's almost as if there's a line in the sand right about here. It hit, and hit, couldn't go much lower. Okay, and we start getting these higher low closes. That is a sign that the market's going back to the upside. We're still in a retracement mode. Market hasn't really decided to go any lower just yet. Profit taking still going on. So we look for the market to move up. Now here's what you're looking to do. You're simply looking to trade from a fib level to the next fib level. If the market keeps moving on up with higher lows, then look for it to go to the next level. So in this case, the market moved up from the 23.6 up to about the 38.2. That's about a 25 pip trade, kind of bounced around and made a move back over. Now then, this is interesting. It makes a pin low here but comes back up and it closes right about these low levels here. And then it gives us some higher lows. Another higher low right there. When you get three higher lows on a diagonal, look for the market to make a move back up again. And sure enough, it makes a move from the 38.2 and pins right at the 50% retracement level. So there's about another 20 pip trade or so right there. Now this morning, as we're going into the US session, we get this strong move down, but it couldn't get below this low point right here. You see these three lows right here? It couldn't get down to that and bounces back up. It held the 23.6 with a higher low. Guess what? We get the swing low here with a higher low. It's another move back up. So some traders in the room caught this move back up to the 38 points. So another 25 pip trade right there. Now let me show you over on the Aussie Dollar. Similar picture here. The market makes a move down and continues to move down into the news. Now coming into the overnight, opening up for Monday here, we see that we actually have a double bottom. You see that as a higher close right here, and we get higher lows. Again, the opportunity to trade it back to the 23.6 and eventually worked up to 38.2, just a little bit shy of it right there. But here was some opportunity to trade to specific levels that you could have picked up a few pips. Wasn't a whole lot, but a few pips on retracement, and it did pin to the 38.2. Now check out the Kiwi Dollar. Now it too, here's the news coming out, and it pushed down a bit lower. Then right around the start of the week here, we're right about the 23.6 retracement level. So again, what we're looking for is, do we have higher lows or higher low closes? Yes, we do. It makes a move up to a level. And it continues. It goes all the way from the 23.6 and marches its way almost to the 618. That's a nice little trade there. If you just trade it from the 23.6 up to the 50% level, that's about a 28 pip trade there. Pretty nice. Well, look what it did today during the U.S. session. During the U.S. session, it comes off the 618 level, turns, and we get these lower highs. Now we trade it from level to level, level to level, and then it takes a bounce to the 23.6 back to the upside. So profit taking is not done just yet. Maybe some more folks got in to see if it'll push up higher. So what I'm getting at is that we did fill the gap. The market did push back. As in the case of the Kiwi Dollar, it pushed all the way back to the 618. And the Aussie Dollar made a push back to the 38.2. And the Euro Dollar pushed back right to the 50%. The pound dollar made a bigger move than this, though, today. Now, the pound dollar last 7 days has moved quite a bit, over 450 pips to the downside. And some folks aren't really buying into some of the things that the Bank of England recently talked about and what Governor Carney had shared. And so we see this big move to the upside here. But look what happened here. Last Friday, we get this sharp move down, get a bounce back up, almost to the 50%, and it comes back down. And look at this. It's near the point of that initial move down. We get a nice little double bottom. A double bottom has a long bias. And look what the market does. It trades up to 23.6 and then the 38.2. Hangs out. Can't get any lower here, just back to the 23.6, makes another move up to the 50, get a little back and forth here, and makes an eventual move to the 618, back to the 38.2 almost, and then going into the U.S. session today, after this little slight move back, what does it do? It makes a move from the 50% level up to the 786 level for about 35 pips there, a nice move. But again, it was due to the retracement based on the big move that we had on Friday. So think of it this way. When you get a big move, big news item type move, treat it like a gap open. Treat it as if the market's made this big move. It's got to find itself. It's got to find where it can work off of. And oftentimes, a retracement of about a 23.6, a 38, maybe a 50%, that's what's usually due for some retracements. If we've seen continual movement in the market in one direction, look for a bigger retracement like we got today in the pound, where it made a move all the way back up to the 78.6. So take a moment, go back over what I've talked about here. The next time you see a big move that you might have missed, look at the next day. In this case, where the market makes a big move to the downside, look for those higher lows. And if the market can't roll back down and retest the bottom, look for a movement back up to a Fibonacci retracement level. And you pick up some pips there. Okay? Well, this is Dean Malone with CompassFX. I hope some of this information will help you out. Y'all make it a great day and get yourself some good trades. We'll talk to you next time. Bye-bye.